Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we saw the Reserve Bank has made another change to the official cash rate, continuing that tighter cycle of monetary policy as we head forward. But we've got a long time now until the next review. What was your initial reaction to the 25 basis point increase?
Yeah, a little surprised given that we had very strong inflation already in the bag. We've had the unemployment rate plunging to an equal record low and GDP growth that's been very strong. You add all of those up, and I think as we previously discussed, the signs were there that if ever you're going to be raising by more than 25, this was probably the time to do it. And especially with it being 3 months until their next review, that's quite a long time. And, they've left a lot of work for themselves, I guess, to get through in 2022. Given the sort of slow and cautious start that they've put through in terms of this OCR rise here. If we look forward, I think over the next year, looking through the numbers, they were picking the OCR to get up to around about 2.25 by the end of next year. So that's pretty much moving at every meeting, except for one through 2022. So quite a lot of work, as I said, to do there, and suggest that, they're sort of on the cautious side, still worried about some of the risks out there around COVID, which I think you'd picked up on.
Absolutely, and I think that was one of the challenges, right, that if our expectation, our forecast was for a 25 basis point move, because that's what we expected the Reserve Bank to do. But gosh, we were personally, if you will, if I was in the decision makers chair, I would have at least gone 50. I think it was a really important time. And we've had some very strong views, of course, here at Metrics. I think my commentary on the analysis this week was bird-brained and spineless. And look, I was frustrated by the bank, in my mind, not picking up those strengths that you talked about. I mean, unemployment at a record low, inflation more than double the midpoint the Reserve Bank targets, GDP coming in at double what expectations were from the bank previously. The economy has been in that hotter place, as we've discussed before. The Reserve Bank, though, taking a much more cautious approach heading forward, seemingly focusing much more on the downside risks. So although we have these persistent challenges and this heat at the moment, the feeling is from the Reserve Bank that there might be that ice bucket coming forward as we head into the traffic light system next year, as we have COVID in the community. How does that change not only our health response and how much capacity we have in the healthcare system to support New Zealanders, but also that thinking of, does it start to dampen consumer spending activity because people don't feel like they can go out and about and spend as much? Is business investment hit because, again, businesses see that heightened uncertainty of COVID outbreaks and the restrictions that might eventually come back into play? The challenge from my point of view was that the first 2/3 of the statement was heavily focused on these possible downside risks. And I say possible because, look, there's still uncertainty about how much of a hit those might contribute. At the same time, though, we have actual real reality hitting with hotter economic times. We haven't had that for quite a while. We saw the Reserve Bank cut by 50 basis points in 2019. Things certainly weren't looking that hot or that slow, actually, at that point. Now that we come through to this very hot period, the question I had is, well, if not now, then when would you? And it reinforces in my mind, Gareth, that we are going to have this, cautious bias on the downside of, that we need to rush to cut interest rates, but raising them, I think, is going to be a lot higher. Regardless, we have seen interest rates go up, not only because of the official cash rate, but also because the markets are expecting that inflation to rise. They're expecting interest rates to continue to head higher. Like you said, quite a continual and fast pace going forward. What does this mean for house prices and for the housing market generally, with those interest rates starting to head up?
Yeah, we've got 1 year rates now up about 3.6%. So they have lifted substantially from the 2.2% rates that we saw as recently as 4 or 5 months ago. So there is a lot of tightening coming through there, but of course, not immediately for households. Most of them will be on fixed rates for another 6, 12, maybe even 18 months in some cases. So it's not going to immediately impact on them. I think where it does immediately start to impact is on actually just the number of buyers that are out there in the housing market looking looking to purchase. But even there, I think at 3.5% or slightly over, it's probably not enough to be squeezing people out of the market. There's bigger things happening there in terms of LVR restrictions for both investors and first home buyers, and obviously quite a lot of talk around debt to income ratios and restrictions there as well. And I think those probably having more of an impact on buyer numbers at the moment. Of course, at the same time, though, we've still got a massive shortage of housing available to purchase. We know we're building as fast as we can, but probably not fast enough at the moment. So at the moment, the balance is probably, in my view, still in favour of sellers. You know, there's probably fewer sellers in the market than there are buyers, and that's going to continue to push those prices up for a bit longer yet. I'm not quite sure how long that is, but I mean, the latest monthly data, we're still seeing prices rising at about 2.5%, 3% a month, which is still a very, very fast rate if you were to continue that over the course of a year. So, yeah, concerns about the housing market, I think, over the medium term, and the Reserve Bank did talk about potential house price falls out into late 2023, early 2024. But let's put those in perspective. It was, I think, a 4% price fall that they had built into their forecasts. And, you know, that's enough to undo a couple of months of the rises that we've just had this year. That's all
lucky.
Well, yeah, if you are lucky, that's right. It's still going to be well up where it was even prior to when the pandemic hit. So, yeah, not a lot there to suggest the housing market is going to slow substantially, or certainly head in the wrong direction, as it were, from the Reserve Bank. And I think possibly, you know, what you're seeing in terms of their discussion and their decision making is they're pretty scared actually of undermining the economy and potentially causing a recession. Now, we've talked about the fact that we're probably in a recession at the moment with the lockdown that's occurred and the Delta outbreak and that sort of thing, but that's supply side stuff. On the demand side, Reserve Bank is worried that if they over tighten too much, then that's going to, you know, really make the economy hit the wall, hit the skids, and hurt growth, hurt businesses, and ultimately hurt households as well. But you've got to be realistic. When you've got an OCR at 0.75%, you're still massively stimulating the economy. Remember that those settings were put in place when we thought unemployment was going to be up in double digits, that the economy was going to be contracting massively, and that COVID was going to have much bigger implications than it has had for the economy. Yeah, I get the concern around consumer confidence that there might be for the next year, but you are still stimulating the economy massively, and I don't see the need for that, given the current situation, and given how much fiscal stimulus is still coming out through the system as well. Like you say, we've got problems with the economy overheating here and now. Yes, some of those might be temporary. Yes, we might see a bit of slower growth next year, but I don't think a 50 basis point rise at this point in time was going to make the sky fall in.
Absolutely. And I think, you know, recognising what you said before, there is a very aggressive rates track going forward. There is a very clear view from the Reserve Bank that they will need to continue to increase interest rates into next year. The worry from my point of view is that they get behind the ball, behind the game, instead of being proactive that they could have been now, starting to shock things a little bit more, making it very clear that rates are not only going up, but they need to go up quite fast. My thinking is still that, gosh, we could still have a 50 basis point hit at some point next year if the bank feels like it is sort of getting too far behind the action, needing to start addressing those pressures if inflation does remain higher for longer and more persistent, but also to cool some of that, you know, what is still relatively hot economic activity. We saw still very good levels of retail spending relative to what we expected in the lockdown affected third quarter. All of that is still suggesting that economic momentum underlying things is going forward. And like I say, from my point of view, moving away from that very stimulatory position into a still, you know, helpful position from monetary policy's point of view, but not the hardcore support we needed when we were into the doom and gloom era of New Zealand's economy. That aggressive rates track will continue, and we'd certainly expect to see interest rates continue to rise. We'll assess how the Reserve Bank thinks about those rates rises and just when we will see the next one and of what magnitude on one of our future editions of Econ Talks.